What is up, you guys? It is Lincoln here, back with another video. In today's episode, I wanted to go over this video that Joseph Carlson put out. If you guys haven't seen his show, go check it out. If you want to watch this video, then hit pause on mine and go watch it. He gives a really interesting take, and it's a very relevant topic, I think, to what's going on in the world and in the stock market today. So I'm basically going to break down a lot of what he said. I agree with almost all of it, and I think it's important to keep in mind. So let's dive into it. So if you guys have totally missed what's been going on, you'll remember back at the beginning of 2020, people were saying cash is trash, and well, Ray Dalio was saying that. And that you needed to be invested fully, and then obviously COVID hit and was a lot worse than what people thought, and we're going to show a clip of Bill Ackman.
Draw down their credit lines because hell is coming, okay? And I felt, it's really, I've never had this experience before in my life. The closest I had was the financial crisis where I'm saying, things are coming, bad stuff's coming. But this was a feeling like I've never had, like there's a tsunami coming, right? The tsunami's coming in, you feel it in the air, right? The tide starts to roll out, okay? And on the beach, people are playing and having fun like there's nothing going on.
So other than the fact that when he was on this call, he was already short the market and was obviously going to profit if the market tanked, and he's a fairly influential person, so keep that in mind about his call. But the market did plummet quite a bit. You saw some of the biggest drops since the crash in 1987, Black Monday. But since then, it has ripped higher, and basically anything that you've bought has gone up substantially. And if you guys watch Dave Portnoy at all, you'll know just how easy it is to make money in the stock market, or so he claims. But there are a few asset classes that we're going to point out here. So here is a couple different asset classes ranked from best to worst performance since the end of 2020. And you can see basically the more speculative, as Joseph put it, the less intrinsic value the asset has, then the better the performance has been. So there is obviously a huge appetite for risk right now. It almost seems like no matter what comes out, if it's risky, the riskier the better for people. And although there is obviously a correlation between risk and reward, generally the greater risk that you take on, then the higher the payoff for doing so, which is why stocks return higher than bonds over the long run. But this has seemingly got way out of hand. To me, it seems like people are taking on risk just for the sake of taking on risk and kind of forgetting about the return aspect of it. So there was another interesting chart that Joseph had in his video. If you don't know what the risk-free rate is, it is basically the Treasury yields. Basically, the U.S. government is seen as the most creditworthy borrower in the world, and any kind of bonds that they sell are basically, there's no chance of default. So that is the risk-free rate. And with them holding the rate down near zero, you can see that pushes the whole graph of the returns down. Without getting into too much of the weeds about it, basically there's a risk premium for the asset class that you're taking. So since stocks are riskier than buying U.S. Treasuries, investors will require, generally speaking, they used to, a higher return for taking on that additional risk. And so you can see that move up this chart. The greater the risk you're taking on, then the higher your expected return should be. And I say should be because that seemingly has completely gone away in this environment. So you can see Joseph added on to the end of this IPOs and special acquisition companies, and then Bitcoin. And I think he did a great job to point those out. It is not rare for IPOs to open and then double on the day that they're opening. Think about Airbnb and Peloton and all these other, especially the tech ones. It's getting crazy. And then special acquisition companies, if you guys don't know anything about them, look into them. They are not a good investment. It's a way for public companies to get listed much quicker. The process is much easier. There's less paperwork. Basically, they're getting bought out by a public company already, which turns them into the public company, but the SPAC basically has no operations besides going out and finding a private company to buy. So they are extremely speculative. They are more speculative than IPOs, and the returns have been even better than IPOs. And then obviously Bitcoin, you guys have seen what that has done, I'm sure. And if you guys think I'm exaggerating about the market's appetite for risk right now, check this out. So Elon Musk tweeted about the Signal messaging app. I'm sure you guys have seen it. And it sent a stock. Signal, the messaging company, is not a public company, but people thought that it was this stock here, and it basically sent it up almost 400% in one day because of Elon Musk's tweet, and it wasn't even the same company. So yeah, I don't even know what to say about that. It's absolutely out of hand. Obviously, the stock has come down since then, but it is still quite a bit above where it was before Elon Musk tweeted about a different company. It's getting ridiculous. If you're with me so far, I guess where does that leave us? So here's a Forbes article. Basically talks about how the Fed is printing money and they're targeting inflation. Now they're trying to average 2% inflation over the long run, which means since it's been below 2% for a number of years, they're going to try and target above 2%. So that basically means printing more money. And given where the labor force is and kind of where COVID is in general, and how basically all of the money that they've printed so far has gone straight back into asset prices, this article is kind of talking about what happened to Japan before 2000. Obviously, they still haven't fully recovered from that, and I don't think the conditions are quite that dire yet, but it is definitely on a similar trajectory. I don't think to the same extreme, but I don't think the author is wrong to point out the correlation there. And then here's an article by Jason Zweig over at Wall Street Journal. He's one of my favorite writers. I highly recommend his column, but he's basically talking about short-term forecasting and how speculative things have gotten, kind of the whole subject of this video, and how we should be looking for companies that nobody's talking about. So obviously Bitcoin, SPACs, IPOs, those are the kind of hot, those are the hot things to buy right now, and those are what people are bragging about, and it's the easy thing to do is try to chase those returns that people got last year. He points out that if Tesla had the same returns that it did last year, then it would be a $6 billion company by the end of 2021, which would make it 3 times the size of Apple, which is the current largest company in the world. So obviously he says that's ridiculous, but the companies we should be looking at are the ones that got hit hard and are pretty good valuations still. He is always an investor. He doesn't ever like sitting on the sidelines, so I think it is timely advice. And speaking of Tesla, do not forget what you're doing when you're buying a stock. So you are buying a portion of the company. So instead of looking at the stock price, what you should be looking at is the market cap. So you can see here, Tesla has a $783 billion market cap and a PE ratio of 1,600. What that's saying is the earnings per share are about 50 cents, just over 50 cents per share of Tesla that you own. So you're paying $800 for 50 cents of earnings per year. So if you were to go buy, say you have a coffee shop in your local town, and they said, hey, for $800 you can buy a portion of this coffee shop, and we are making you the equivalent of 50 cents for every $800 share you buy. You would say, there's not a chance that I'm buying this coffee shop. You're not going to put your money in there because you're never going to pull it back out. That is the same thing with Tesla. The thing that has driven the PE ratio way up is that unlike the coffee shop, people expect Tesla's earnings to grow. But I mean, if you do the math, their earnings need to absolutely balloon for this to be worth anywhere near $800 billion. So I will make a future video about kind of how I value stocks. But you need to look at stocks in terms of their overall market cap and compare that to the earnings that you're getting. And like Tesla, they don't pay a dividend, so you're paying 50 cents, or you're paying $800 for 50 cents a share in earnings, but you're not actually getting that 50 cents in earnings as of right now. So you're paying on the belief that they will grow and grow basically exponentially for a long amount of, over many, many years, to be worth the valuation that they are, and then that they'll start paying a dividend out for that. Or you're buying their shares because you believe there's a bigger sucker out there that will pay more for them than you did. So keep that in mind. So now let's check out another clip from a guy named Jeffrey Gundlach.
Or at extraordinarily high valuations is where we are. That's being supported by massive amounts of stimulus, obviously. And one of the things that's fascinating is you go back for decades of stock market data, there are many valuation metrics that are in the top 1 percentile of overvaluation. So the thing that's keeping it going, though, of course, is the Fed. The Fed, with rates at zero and promises to stay at zero, allows for valuations to be, record-breakingly high. And that's where we are. Also, what's very important for a lot of people to understand is that many things that have been persistent trends relative to equity performance have started to reverse one after another after another. For example, emerging markets are outperforming the United States. Value is outperforming growth. Weak balance sheets are outperforming strong balance sheets. It goes on and on.
So where does all this leave us? I'm going to jump into my portfolio here in a second, but you can see my Fidelity is sitting at $25,000, $459 at this moment. So let's jump in and talk about things and what I'm planning to do here in the short term and midterm. Alright, so here's what I'm at. You can see the account balance up in this top corner. This is just the Google Sheets that I made to kind of track all my positions. I have everything formulated in here to pull in the current stock prices. So once I enter the ticker that I own and then the shares and my current cost basis, everything else is calculated for me. With the exception of my options, I haven't been able to figure out how to get those current prices in, so I've been entering those manually. You can see here's that 3D Systems call. Up quite a bit on that guy. If you guys missed my last couple videos, they basically sold part of their software business and then significantly increased their revenue estimates for the fourth quarter. So that shot them up pretty high. They've been up over $30 a couple different times now. So that is that. So yeah, here are the rest of the positions. I sold Facebook and Twitter. So it was partly for fundamental reasons, but more for moral reasons, I guess. I don't want to get into that right now. But after my last video, I kind of decided I wanted to, I guess, limit the number of positions that I had. I had quite a few companies, so I've started to sell a couple, take some profit, and then I'm looking to add a couple of these elite positions. Obviously, these end up being significant portions of my total portfolio because my portfolio size isn't that big yet. But hopefully those will be less drastic in the months and years to come. But expect to see a few more of those. So same thing with 3D Systems, except for I went another year out. So these are both expiring in January of 2023. You can see the Dropbox, I have a $10 call. And then Delta Airlines, I got a $20 call. So I owned a little bit of Delta and some Alaska and ExxonMobil. And those, I mean, given that they are pretty well-established companies and they're consumer cyclicals, and they all got beat down by COVID pretty well earlier in the year. I figured they'd be moving up pretty much in tandem, so I picked my favorite out of those three, so Delta Airlines, and that is how I ended up buying that call. And then you can see the rest is the same. I shuffled where I have my indexes a little bit. So anyway, doing some consolidating there, but everything is basically the same. That's the update. And then I have that all feeding into. So you can see I own VT in both my Roth and my traditional. So over here it's just combining those positions, so I know my total equity, and then that's just in a chart over here. So that is what this is looking like, and I'll probably be referring back to this quite a bit in the future. But that to say, hopefully you guys enjoyed this video. I agree with Joseph quite a bit on what he's saying, and he's basically came to the conclusion that he's staying invested. He's definitely going to stay long the stock market, and I totally agree with that. But asset prices have all increased very significantly, a lot of it due to cheap interest rates. I mean, the housing market has gone way up across the US, so you got cheap interest rates and then also stimulus, and there's just a lot of money floating around. But you can see, I showed you a little bit before, that inflation is still low for a lot of things. So that has driven up asset prices quite a bit. But that chart, I'll show it again here. It shows that basically the top 10 companies, those are the ones with the very expanded PE ratios, whereas the bottom 490 companies in the S&P all are a little bit over their average, but it is very marginal. So those are the type of companies I'm going to be looking for. Obviously, I've made a couple videos about small cap companies and how I like to take bets, and if you look through this list, that is where I have a lot of my individual positions. But I do see the valuations for those bottom 490 companies in the S&P, basically everything besides the top 10, those valuations are still, I don't think they are overpriced at all. So I'll probably be looking to add certain positions like those. So you'll see that Delta Airlines position, probably you'll see a few more companies like that in my portfolio over the next month or two. Also, I like value over growth right now, and I still like small cap over large cap. And both, yes, large cap growth has absolutely exploded over the last 10 years, which is part of why those top 10 companies have such expanded PE ratios and valuation measures. So I guess I'm tilting further towards small cap and value than I otherwise would. So you can see I have the VBR and VEU index funds. Those are basically those plays, is trying to avoid just the large cap growth companies taking over too much of my portfolio. Thank you guys for watching. I hope you found this information useful. If you can hit the like button, it really helps out the channel a lot, and subscribe if you're new and want to see more like it. I'll catch you guys in the next video.